Now, you would know that when you buy a stock, you're actually buying a piece of an underlying business. And you would think that the share price is tied to the business performance. So if the share price goes up, it means the business is doing better. If the share price goes down, the business is not doing really well. Now, is that always true? No, it's not. Generally, it's true, but there are times when the stock price and the value of the business can go in opposite directions. And that's when stock markets severely misprice the true value of the business. So in this video, we're going to take a look at some examples of it happening right now. How do you identify it and how do you take advantage of it? So you may have read by now that Charlie Munger, who is Warren Buffett's right-hand man, he just increased his stake in Alibaba by 83% as the share price went down. So he initially invested about 40 million in Alibaba about 9 months ago at about $245 per share. Since then, Alibaba's share price has dropped all the way down to $150. And what did Charlie Munger do? He bought more shares. He bought another $20 million worth of shares at a $182 average price. Now, some of you will be looking at this guy and thinking, is he nuts? Why is he buying the stock when the price keeps going down? Some of you think I'm nuts because I've been saying that Alibaba is a great business. You say, Adam, it's a great business, but price keeps coming down. And you are buying too, you're holding a stock. Are you nuts? Or you may be thinking that, Charlie Munger has really big balls, right, to buy such a risky stock, and that I'm also very aggressive. The reality is this: if you have been studying Charlie Munger, you would know that Charlie Munger is one of the most conservative investors in the world. And if you have been following me for many, many years, you know that I am also one of the most conservative investors in the world. So if we are so conservative, why are we buying a stock that seems to be very risky? The reason is because to investors like Charlie Munger and myself, Alibaba is a very, very low risk investment. That's right, very low risk. You say, how can it be low risk? The price keeps going down 40%. Understand something. Risk is in the eyes of the beholder. You see, to many people, they define risk as the short-term price movement. That if they think that the share price can go down a lot, then that investment is risky. But I see it very differently, and Munger sees it very differently, right? As investors, we determine risk not by the share price movement in the short term, but we determine risk by the underlying business performance. In other words, as long as the business is making money, generating free cash flow, and will continue to make more money, then it's a very safe business, regardless of the share price in the short term. So in the short term, the share price can drop 20, 40, 50%. To me, that's not risk. I don't care about that. Why? Because in the short term, share price is driven by manipulation, by news, and by emotions. And that can change very fast. And once the emotions change, the news changes, the narrative changes, the share price can double or triple very, very quickly. As long as you buy a stock where the underlying business is a great business, it makes a lot of money, it's kind of like a monopoly, there's no close competition like Alibaba, you know that there's no risk, or there's very, very low risk, because that it's a matter of time, the share price will soon reflect the true value of the business. As Benjamin Graham once said, in the short run, the stock market is a voting machine. But in the long run, the stock market is a weighing machine. So what does that mean? You see, in the short run, whether the stock price goes up and down depends on people voting for the stock. In other words, if more people buy, price goes up, more people sell, price goes down. And in the short term, people tend to vote or buy and sell not based on logic, not based on the fundamentals of the business. They buy and sell based on news, emotions, speculation. And so people tend to vote very unintelligently in the short term. It's the same as in politics. You guys know that in politics today, people vote for a candidate not based on facts most of the time. Sadly, most people, they vote on a candidate based on emotions, based on party loyalty, or based on fake news or misinformation. So the same thing in the stock market, right? In the stock market, the stock of a very good business can still go down 30, 40, 50%, even though the business is doing well. Why? Because of, again, emotions, misinformation, and speculation. But that can change very fast. The moment the news changes, the emotions change, the share price can double and triple very quickly. So ultimately, where the share price will be depends on the weight of the business. Is the business really making money? If the business makes a lot of money, it keeps growing its cash flow, the share price will be a lot higher than where it is today. Now, if you do the math and you calculate based on Alibaba's, for example, their free cash flow generation, their profits, and their growth, even the lowered growth based on regulations, you know that the shares are worth, well, the business is worth at least about roughly $300 per share. Roughly about there, maybe $290, $280, but roughly about $300 per share. And right now it's selling at $161. So as an investor like Munger and myself, we know it's worth $300. All right. So wherever the share price goes in the short term, it doesn't bother us. It can drop another 20%, doesn't bother me one bit, because I'm looking at where it's going to be in the long run, in the next 2, 3, 4, 5 years. Now, how long will it take for the emotions to change, the sentiment to change? How long will it take for the market to reflect the true value of the business? That's something that no one knows. No one can predict when the emotions will change. It could change in 1 month, it could change in 1 year, it could change in 3 years. No one knows, right? But I would give myself, for this investment, about 3 years for the price to double from where it is today. So if the price doubles in 3 years, that means on average, I'm getting about a 25% return a year, which is not bad, right? Now, in a worst case scenario, if it takes 5 years for Alibaba to double, it takes 5 years, then roughly I'm getting about 14% compounded annual return a year. And that's the worst case scenario. So if you ask me, as an investment, 25% return a year, it's not bad. Worst case, 14% return a year. So people have been asking me, should I buy Alibaba? And if I already have Alibaba, should I add more shares? Well, it depends. Are you entering it as a trade, or are you entering it as an investment? So it's a big difference, right? So if you're looking at it very short term, it's a short-term trade, maybe not, all right? Because Alibaba in the short term could still go lower. Why? Because the trend is still down. It's still on a downtrend, so low could still go lower in the short term. So if you're a trader, you might as well trade something which is on an uptrend, all right? But if you're an investor and you're taking, again, a 1, 3, or 5 year view, sure, Alibaba's a sure bet. Why? Because, again, you're buying a great company, less than what it's worth, is going to double in, again, 2, 3, 5 years. But again, it won't go up in a straight line. You'll just go up and down. You never know where it's going to go in the short term. For example, the last few days, you could see a huge surge in the share price, right? There's a huge bounce, but it doesn't mean that the trend has changed yet. Let me show you the trend on the charts, right? Take a look at the short-term trend. So if you look at the daily candles, let's look at the daily candles over here. Now on the daily candles, you can see that it's still very much on a short-term downtrend. Downtrend, you can see wave up, wave down, wave up, wave down, right? You can see the wave patterns over here, right? So it makes lower highs and lower lows. So it's still a downtrend. So right now it's kind of like going up, all right? But if it hits this resistance, the 50 moving average looks like a strong resistance. If you can't break this resistance, it could easily come back down again, right? So short term, it's still bearish, all right, for now. But if Alibaba, if you could break above, let's take a closer look at this, right? If we could see this 20 EMA, the red dotted line, if that 20 EMA can cross above the 40 EMA, that would be the first signal in the short-term trend change, where we get a short-term uptrend. And ultimately, when the 50 moving average, the blue line, can cross back above the 150 moving average, the green line, and start sloping up, that will be the ultimate confirmation of the medium to longer term trend. Some people would say, hey, can I wait for the 50 to get back above the 150, the 20 above the 40 to add shares? Yeah, you could do that, right? But for me, I've been buying even though the trend is still down, because Again, I'm taking a long-term view, so I don't really care about the short-term trends. But what's interesting is this, although on the daily candles, the downtrend is still very much in force, but if you take a look at the weekly candles, you see something interesting. On the weekly candles, what has just happened is that we just closed for the first time with a bullish engulfing pattern. There's a bullish engulfing pattern, and it didn't just close on Alibaba. If you look at most of the Chinese companies like JD.com and so on and so forth, they closed with a bullish engulfing candle pattern. So this is a bullish reversal pattern on candlesticks. But it did not happen at a strong level of support. So I'm not 100% convinced that this would be the ultimate reversal. It may, but it would be better if this was at a strong support level. If you take a look at the charts, you zoom out, you can see that actually there's a very strong support here at the 130 level. In fact, I've been selling puts on BABA at 130, right? So it did not get down to 130. You can see that it hit about 133 and then it started reversing. So, we'll take a look at where it goes next week. Like I said, I don't really care about the short term because it will double eventually. But if we can continue to go up, and like I said, if the short-term trend can change, then that would be a strong signal of the change in trend for Alibaba. So are there other examples of companies that are great and the share price is totally different from the true value of the business, giving an investor an opportunity? You bet, it happens all the time. And one of the classic examples that I like to share with you, is the example of how Warren Buffett bought the Washington Post stock at 80% below its intrinsic value. Now, this is a classic story. It happened a long time ago in 1973. So at that time, what happened was the Washington Post, the stock price was selling at $38 per share. Now, because of some bad news, like they were going to lose their TV license and, emotions and negative press and all that, the share price fell from $38 per share to $20 per share. Now, at $20 per share, if you multiply by the total number of shares, it gives you the market value or market cap of $100 million. So in other words, the whole business was selling at $100 million on the stock market. But Warren Buffett, he did his calculation, right? He did the math by calculating the intrinsic value of the business based on its cash flow, its assets, and he found that the business, what it owned, was actually worth $500 million. And if you divide it by the number of shares, it gives you an intrinsic value of $103 per share. So in other words, again, the stock is worth $103, but the share price is only at $20. So again, it's 80% undervalued. So what did Buffett do? He said, you know what, I'm going to buy the stock. So he invested $10 million at $20. And did the share price go up the next day? No, in fact, the share price dropped further down to $16. So did he get upset? Did he get worried that I made a bad investment? Of course not. Because true investors, they don't look at the short-term price movement to determine whether it's a good investment. They look at the underlying business. He said the business is still making money. The business is worth $500 million. The shares are worth $100. If it goes to $16, $5, who cares? I'll just buy more shares, right? Because he's looking at the underlying business value. So what happened after that? Sure enough, after a couple of years, after the bad news was over and people came to their senses, the share price soon reflected the true value of the business. In fact, the share price grew. By 2006, his $10 million investment had grown to $1.5 billion. That is 150x, 150 times his original investment, right? There was a slight typo that it's not 15x, it's 150x. And that works out to be $1,500 per share before adjusting for stock splits. Check out Buffett's interview on Charlie Rose on YouTube. And this is at the 15-minute mark, part 2, Warren Buffett on Charlie Rose. And he talked about this investment. And Charlie asked him, he said, hey, why didn't other people see the same opportunity that you saw? And if it was so great, why didn't everyone buy the shares? And what Buffett said was really interesting. He said that, you know what? all the analysts, all the professional fund managers agreed that the business was worth $500 million. But the shares were 80% undervalued. They didn't want to buy it. In fact, they were dumping it, they were selling it to me. Why? Because they were more concerned about the short-term price movement going down and making them look bad than focusing on the underlying value of the business. So by thinking short-term and not thinking long-term, they missed out on this opportunity. So this is a great example of how share prices quoted by the market can be totally irrational and totally divorced from the intrinsic value of the underlying business in the short term. By focusing more on the intrinsic value of the business and taking advantage of the market's emotional mispricing and being patient, you can make a fortune. So making money from the stock market is actually very simple. Once you identify great businesses, wait for the market to misprice the stock and you get it when it's undervalued. And this happens every few months or few years when the media releases some kind of bad news. So for example, Facebook, data scandal, price, boom, comes down. Find yet again, Cambridge Analytica scandal, bam, price that comes down again. Facebook shares slide as Starbucks and major brands boycott Facebook, boom, comes down again. Tech stocks collapse because of bond yields rising, bam, comes down again. And most recently, what happened, right? There was this outage. Facebook went down, WhatsApp, Instagram went down, they had a whistleblower complaint, and the share price, boom, came down again, right? And right now, Facebook's intrinsic value is about $389. And because of that bad news, it's now being priced at $300. So again, it's undervalued. So every time there's bad news, what happens? Market makers will drive the price down, dumb retail investors will sell in panic, and that's when smart investors, value investors, will start to accumulate shares. And sure enough, the price will go up again because the business is worth a lot more. Remember, be greedy when others are fearful. Only when it comes to good businesses, it must be a fundamentally good business in the first place. So this is Adam Khoo. May the markets be with you always. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.